Okay, so here we go. We're going to continue on with Chapter 5, and you probably feel like Chapter 5 there's going to be a lot of information in Chapter 5, and you're right. And we're halfway through Unit 2. So in Unit 2, we only have Chapter 4 and Chapter 5. And when we get done Chapter 5, you're going to have a sense of the whole accounting cycle in terms of recording transactions, and so that's a good thing. So if you recall, we were learning on our last lesson the fact that the capital account was not very user-friendly. It did not allow for the owners of the financial statements to be able to make decisions based on the capital account because we couldn't tell how much money the business was making. So what we want to do is we want to add 3 new accounts: revenue, expenses, and drawings. And these 3 new equity accounts are going to allow the owner to be able to see how much money the company has made in an accounting period. It's also going to allow me to see how much money the owner has taken out of the business for a specific period of time. So let's go through and look at a couple of new equity transactions so that you can see how these work. The first one is when we have revenue. So here's a revenue transaction for Eve Boa. She's a lawyer, has a law firm, and she draws up a legal agreement for Jay Basso, a client, and for her services is paid a fee of $450 in cash. So what 2 accounts are affected? Well, we know that cash is affected, and cash is an asset, and the cash is going to be going up, and we know that assets increase on the debit side, so we're going to debit cash $450. Now, what account are we going to credit? Before we used to credit owner's equity or capital, but now we have this new account called fees earned. And so now we're going to credit fees earned, and we credit fees earned because we know that fees earned increases capital. We know that capital increases on the credit side, and therefore fees earned is going to have credit entries. The next types of transaction we're going to look at are expense transactions. So the first example is Eve Boa, and she writes a check for $3,300 cash to pay monthly rent. So again, what 2 accounts are affected? Well, we know that rent or that cash is affected, and it's going to go down, and assets go down on the credit side. So we're going to credit cash. But what account are we going to debit? Again, we used to debit capital, but we no longer can do that. We have to debit something else. So we're going to debit an expense account. And so here we are crediting cash, $3,300, and now we're going to debit the rent expense, $3,300. And we know that an expense decreases capital, capital decreases on the debit side, and therefore we're going to debit rent. The next one is Eve Boa receives the monthly utilities bill, and you probably can't see that, the monthly utilities bill, and for $395 for municipal gas. So the bill is not immediately paid. So again, what do we do here? What are the 2 accounts that are affected? Well, we haven't paid the bill yet, so we know for sure accounts payable is affected, and accounts payable is going to be credited because liabilities increase on the credit side. What other account is affected? Well, before, when it was a bill or an expense, we would debit capital. But in this case now, we have our new expense accounts. So credit municipal gas, accounts payable, and we're going to debit our utilities. This includes gas, hydro, water, and so on, all of our utilities. And we're going to debit that because, again, we know that expenses decrease capital, and therefore they're debited. The next kind of transaction that we're going to look at are drawings. And so drawings are when the owner takes money out of the business for their own personal use. Now this part's really important. Drawings, they are not found, not on income statement. They are found on the balance sheet. So they are not used to calculate net income. So the first example here, Eve Boa, the owner of the business, withdraws $1,975 for her own personal use. So we know that we're going to credit cash because cash is going to go down. And what account are we going to debit? Well, before we would debit owner's equity or capital, but now we have a drawings account. And so here we have, and sorry, I shouldn't have done that, but written on there. But we are going to debit drawings because we know that drawings decrease capital, Capital decreases on the debit side, and therefore drawings are debited, and we're going to credit bank. Another situation that might happen is that Eve Boa might purchase something for her personal use, but purchase it through the business. So in this case, Eve Boa purchases a coffee maker through the business. So she orders it through the business from a company called Kitchen Plus, and for her own personal use. So again, this is still a drawings situation. So we haven't paid for it yet because it doesn't say that the invoice is paid for. But in this situation here, we're going to credit, let's say the coffee maker was $85. Okay. We're going to credit accounts payable, $85. And again, we're going to debit drawings, $85. So those are the three new transactions that you're going to have to deal with. Now we're going to look at a couple of accounting standards as well. So the first one isn't really an accounting standard, but it's a concept that you need to understand. So you'll hear this term fiscal period in accounting quite often, okay, fiscal period. And what it means is that unlike a balance sheet, the income statement, which is what we're looking at now with revenues and expenses, tells us a story, or is a video in this case, for a given period of time, tells us a story. And so usually the story is for a 12-month period, so for 1 year. So the income statement is telling us how much money we earned for 1 year. So when we're recording the fiscal period, or the when of the date of our income statement, we need to record it for the year ended December 31st. So now we're going to add this part on all of our titles for our income statement. So when we're writing in the date, we're going to say for month ended, or for year ended, or for quarter ended, or so on. We also have some new accounting standards that we need to consider when we're looking at income statements. The first one is called the time period concept, and this is directly related to the fiscal period. The time period concept says that accounting will take place over a specific period of time known as fiscal periods. This means that if our business is reporting on an annual basis, we're going to always report on an annual basis. That way, the financial statements are going to be comparable, because when we look at an income statement from last year and an income statement for this year, we know that they both show 12 months of income, and so we can compare them. If one only showed 9 months of income and another one showed 10 months of income, we couldn't compare them as easily. So specific periods of time. The next one is and I'm going to turn me off. The next one is the revenue recognition convention, and it says that revenue must be recorded, and this part's very important, recorded at the time the transaction is complete. So this is a critical event. This is when the service is performed. Okay, regardless if we've received payment or not. So when do we record revenue? Well, when the service is performed. So this usually occurs when the bill is sent to the customer, or after the work is complete. That's when revenue is recorded, not necessarily when payment is made. For large construction projects, like remember when the school redid the windows, that took a couple of years to complete that construction. The construction company would send periodic bills and record the revenue at the same periodic intervals. So revenue would be recorded when the bills were sent out for long-term projects. And finally, the last one is called the matching principle. This is my very favorite principle. This is one I want to make sure that you all memorize. So the matching principle states that expense items must be recorded, or related to revenue earned, must be recorded in the same period as the revenue that it helped to earn. So this is a little confusing, but we want to make sure we're recording expenses in the same time period as what the revenue related to it helped us earn it. So we're going to get into more of when this might not be quite so clear when we look at Chapter 8. But what I want you to know is that the matching principle is the very most important principle that you're going to learn in this course. And I really want you to think about why it's so important. Why do we want to record expenses in the same time period as the revenue it helped earn. Why do we want to do that? So I'm going to leave you with 3 critical thinking questions, and I want you to have a response to these 3 questions tomorrow at the beginning of class. The first one, if you were to start your own business, how long would you want your fiscal period to be? Why? So think about it. If you were to start your own business, how often would you want an income statement prepared? What period of time? Could it be monthly? Could it be every 3 months or quarterly? Or do you want it annually? And describe why. The next question is, if assets have a debit balance, then why do expenses also have a debit balance? Explain. Assets are a good thing, or they're something we own, and expenses, well, expenses aren't something we own, but they're something we have to pay for. They also have a debit balance. So how come they both have a debit balance? Can you explain that? And finally, why do you think the matching principle is so important? I really want you to think about that. Why is the matching principle so important to accounting and to accountants? Good answers to these questions will be discussed tomorrow, and you may win a prize. All right, have a good night. Thanks for watching.